Hi, everyone. In this chapter, we're going to talk about liabilities. There are two kinds of liabilities. One is called current liabilities. The other is called long-term liabilities. So we're going to talk about each of those, how to account for each of those, different kinds of current liabilities, what is the major kind of long-term liabilities, and what is the accounting. And then in the end, we're going to talk about how liabilities are reported. So what is current liability? The definition of current liability is it is a debt that a company expects to pay within 1 year or one operating cycle, whichever is longer. So that's the definition. And examples of current liabilities, we have short-term note payable, account payable, earned revenue. So all of those are expected to be paid within 1 year or one operating cycle, whichever is longer. Accrued liabilities and current maturity of long-term debt. So what is current maturity of long-term debt? If the firm has a long-term debt, which matures in maybe 3 years, and then part of that debt is expected to be paid within 1 year, and that part, which is expected to be paid within 1 year, that is called current maturity of long-term debt. Within current accrued liabilities, so what are accrued liabilities? Sales tax payable, payroll and payroll tax payable, interest payable. Those are examples of accrued liabilities. And we're going to look at those in more detail. So the first major kind of current liability is short-term note payable. And here's an example. Suppose the bank agreed to lend 100,000 on September 1st. If the firm signed 100,000, 12%, 4 months notes payable mature in January 1st. First of all, the agreement is signed on September 1st. So what is the journal entry on September 1st? And then what is the adjusting entry on December 31st, which is the financial period end date? And what is the journal entry on January 1st? When this note was paid? So here, this is September 1st. The firm gets the money, and 12/31st, financial year end date, January 1st, when the firm pay back the money. So those three critical dates. First of all, on September 1st, when the firm get the money, the journal entry is to debit cash 100,000, credit note payable 100,000. And then after 4 months, at the financial period end, the firm needs to accrue for the interest, even though that interest hasn't been paid yet. But because the firm has used this 100,000 for 4 months, so it has generated interest, which is to be paid. And how do we calculate this interest? 100,000, that's the face value of the note, multiplied by 12%. So this is the interest rate for the whole year. And we multiply it by 4 months over 12 months. So this is going to give you $4,000, which is the interest for the 4 months. So we debit interest expense 4,000, credit interest payable for 4,000. And then at the beginning of next year, when the firm repay this note, together with the interest, they actually paid 4,000. 100,000 is the principal of this note. 4,000 is the interest that's going to be paid in cash. So those are the general entries with regard to short-term notes payable. Another important kind of current liability is called sales tax payable. Here's an example about sales tax payable. So the sale of 10,000, sales tax 600, which reflects a sales tax rate of 6%. What is the journal entry? So the journal entry here is the firm gets cash 10,600. However, only 10,000 is the firm's sales revenue. Another 600, that's actually a liability for the firm. The firm collects the sales tax and then which is to be paid to the to the tax authority, maybe in a month or in several months. So so that's why this is a liability for the firm. The firm just temporarily collect this cash to be paid to the tax authority later, and that's why it's called sales tax payable. It's a payable for the firm. It's not part of the firm's revenue. So this is how to account for sales tax payable. Earned revenue. So we have talked about this before. Those are revenue received before the company deliver good or provide service. And the example is the university sell 10,000 season basket football ticket at $50 each for its 5-game home schedule. And the home schedule, the game hasn't been played yet. What is the journal entry for sale of the season ticket? So the journal entry is to debit cash, credit earned ticket revenue. So this is $50 each multiplied by 10,000 tickets. And then this is for 5-game home schedule. As each home schedule is completed, what is the journal entry to record recognition of revenue? So when each game is played, now we can recognize revenue. And then the journal entry is credit ticket revenue for 100,000. So how do we get this 100,000? That's 500,000 divided by 5 games. So each game is 100,000. And we debit earned ticket revenue for 100,000. So this is a journal entry after each game is played. This is earned revenue. We have already talked about it in previous class, actually. And then current maturity of long-term debt. So that is portion of long-term debt that comes due in the current year. So that part of the debt was classified as long-term debt before. And as they are coming due, they are reclassified into current liability. And this is only a reclassification issue. No journal entry is required to recognize the current maturity of long-term debt. It's only when the firm is reporting it classify, do a reclassification. The other kind of current liability is called payroll and payroll tax payable. And in order to talk about this, let's talk briefly about payroll. So if you have worked before, you should know that your gross pay doesn't equal to your net pay. Your net pay is whatever pay you receive. And you also have a gross pay. Your net pay is calculated based on your gross pay. And what's the difference between those two? The difference is your payroll deductions and what are included in the payroll deduction. So your federal income tax is withheld from your pay, state and city income tax, and FICA tax, insurance, pensions, or unit dues, and if you choose to have any charities donated. So those are withheld from your payroll, and those are called payroll deductions. And if you are an employer, from your employer's perspective, instead of withholding those from your payroll, employer should also pay the employer's share of FICA tax. So whatever that is deducted from your payroll, employer should match that as well. State and federal unemployment tax. So those are in addition to those deductions, what employer needs to pay in addition to that. And now let's talk about the journal entry. So suppose the employee earns wage of 60,000. Withholdings related to this wage are, so we have FICA, we have federal income tax, state income tax, costs incurred for unemployment tax and federal, for federal and 150 for state. What are the journal entries? So there are two journal entries here. First, the employer needs to make a journal entry to record your payroll. And the journal entry is to debit salary and wage expense, 60,000. And this 60,000, this is your gross pay. However, eventually, your net pay, which is salary and wage payable, which is eventually what is payable to you. This is your net pay. This is only 46,910. And the difference between those are your deductions. So what are those? Your FICA tax payable. So this is to be paid to employee. And all of those are paid to the government agencies. FICA tax payable, federal income tax payable, state income tax payable. So those are withheld from your pay, and your employer is going to pay them to the tax authority. This is the first journal entry that employer make. The second journal entry the employer make is to record employer's payroll tax. So whenever employer is pay payroll to you, it needs to pay additional tax for you because they hire you. And that in this journal entry is to debit payroll tax expense. And they need to occur, they also occur FICA tax payable. So whatever you paid, they need to match that. And also the federal and state income unemployment tax. And those are called payroll tax expense. Those are different from your salary and wage expense. So this is the payroll. And when those payroll are made to you, they debit salary and wage payable credit cash for this amount. So this is whatever is paid to you eventually. So we have talked about different kinds of current liabilities. Now let's look at long-term liabilities. What is long-term liability? Long-term liability, those are obligations that are expected to be paid after 1 year. So that is the definition. And one of the major type of long-term liability is bonds. What are bonds? Bonds are a form of interest-bearing notes payable, and this is how a bond looks like. So a bond usually have the issuer of the bond, the maturity date. So here, when is the bond going to be due? The face or par value, $5,000, this amount. And what is the contractual interest rate? So those are the basic elements of a bond. And what are major types of bond? So bond can either be secured or unsecured. It may have a collateral or it may not. Bond can either be convertible bond, which means that it can be converted into stocks. It can also be a callable bond. The firm which issued the bond can call it back before the maturity of the bond. So those are the major types of bond. And how do we determine the market value of a bond? This is basically the basic DCF approach to calculate the net present value of the bond. We use the firm's dollar amount to be received. So the firm's the bond's future cash flow, when those cash flow is going to happen. So suppose we have 3 years, the bond is going to mature in 3 years. In the first year, the bond is going to pay out $100 interest. The second year, $100. The third year, $100 multiplied by $1,000, the principal, the face value of the bond. So it depends on the dollar amount to be received, 100, 100, and 1,100. The length of time until the amount are received. So for the first 100, it's going to be 1 year. The second 100, 2 years. The first 1,100, 3 years. Market value of market interest rate. So what is the market interest rate? Suppose it's 8%. Then what we do in the DCF approach in determining the net present value is we discount the first $100 over 1 year. The first $100 over 2 years. And discount the last $100 over 3 years. So this is the net present value of the bond. And this is usually the market value of the bond. And these are the market rate of interest. It is the rate investors demand for loaning the funds. And this change every minute on the market. It's changed just continuously. So this is the basics about the bond. And how to account for the bond transaction. So there are several critical events here. First of all, when the firm issued the bond, what is the journal entry? And when the firm accrue interest, pay out interest, what are the journal entry? When the firm redeem buyback bond, what is the journal entry? And when bondholder convert bond into common stock, what is the journal entry? And in this class, we're going to cover the first three, the journal entry for the first three. When the firm issue the bond, accrue interest, pay out interest, redeem the bond. And then, so one thing to pay attention is, if the bond has already been issued, so someone in the secondary market bought the bond and then they sell it to someone else, from the firm's perspective, it has nothing to do with the firm because the bond has already been sold. So no accounting record needs to be made when bondholders sell their bond to some other investors. What matters here is only when the firm sells the bond to the investors for the first time, the firm needs to make a journal entry here. So how to account for the issuance of bond? A bond can issue either at face value or at discount or at premium. What do we mean here? So supposedly the face value of the bond is $1,000. If a bond is issued at face value, which means that when the firm issued this bond, it's getting $1,000. However, when the firm issued the bond, it's not always equal to $1,000. Sometimes the firm may issue the bond at discount, sometimes at premium. Or in other words, sometimes when the firm issued this $1,000 face value bond, they may only sell it for $919. Some other time, they may be able to sell it for $1,200. So what determines the different price this bond can be sold? Actually, no matter what price it's always the fair price of the bond. But what determines that sometimes a bond can be sold for more than its face value, sometimes less than its face value? It depends on the relationship between the contractual interest rate. This is also called coupon rate, and market interest rate. So what is the contractual interest rate? This contractual interest rate or the coupon rate, this is what we use to calculate the cash interest payment of the bond. So supposedly in the previous example, the face value of the bond is $1,000. However, each year the interest is $100. And this interest is calculated based on $1,000 multiply the coupon rate, 10%. And so each year the interest is $100. This coupon rate, contractual interest rate, this is determined when the firm issued the bond, and it doesn't change at all over the lifetime of the bond. However, versus this market interest rate, this is the rate determined by the market. So for those investors who want to invest in this bond, how much is the interest they require? And this can change every second on the market. It can be more than 10%, it can be less than 10%. If this rate is less than 10%, which is, for example, if it's 8%, the net present value of the bond is going to be more than the face value of the bond. So you can, in order to explain it more deeply, there's some math here. But just as a brief explanation, so when we calculate net present value, we discount the future cash flow over kind of 1 plus some kind of market interest rate. And if this rate goes down, the net present value of the bond is going to go up. So that's why we can sell it at a premium. However, when this goes up, net present value goes down. That's why we're selling it at discount. So this is just a very simple explanation. And to go down to the more basic explanation. There's some mathematical proof there, and which is beyond this course. So let's first look at if a bond is issued at face value. So supposedly this firm issue 100,000 5-year 10% bond at 100. So 100% of face value. What is the journal entry? And the journal entry here is basically to debit cash, credit bonds payable for 100,000. This is pretty straightforward. And let's continue the previous example. Suppose the interest payable annually on January 1st, and assume monthly accrual have not been made. What is the journal entry on December 31st to recognize interest expense? So this bond is issued at January 1st, and now 1 year has passed. The firm hasn't paid that interest yet, but the firm has the investor has held this bond for 1 year. So the bond issuer has used that borrowed money for 1 year now. So that's why they need to accrue for the interest expense, which has happened so far. The face value of the bond is 100,000. And each year, the interest is 10%. So that's $1,000 per year. So the journal entry is to debit interest expense. Oh, sorry, 10%, that's 10,000. Interest expense for 10,000, credit interest payable for 10,000. And then on January 1st, when that interest is actually paid, we debit interest payable and credit cash. So this is how to record the issuance of the bond and the interest payment for a bond which was issued at face value. Now let's look at what if the bond is issued at discount. The face value of the bond is 100,000. However, it is sold for 98,000. And here in this example, the firm gets cash 98,000. The bond payable is recorded at face value of 100,000. And there's a difference here. The difference is recorded as discount on bonds payable. And this discount on bond payable, this is a contra account to bond payable. Or in other words, the net book value of bond payable is 100,000 minus 2,000. So that's 98,000. This is the net book value of bonds payable. So this is when bond is issued at discount. Then how about if bond is issued at premium? So now the face value is 100,000. However, the bond is issued at 102,000. And what is the journal entry? So now the firm gets cash 102,000. However, bond payable is always recorded at face value. And then the difference between those two, 2,000, that is recorded as premium on bonds payable. And this account is added to the bonds payable account. So the net book value of bonds payable is going to be 102,000. So that's the net book value of bonds payable. We have talked about the issuance, the accounting for the issuance of bond. Let's look at how to account for it when the firm redeemed the bond at maturity. So regardless of the issuance price of the bond, subsequently, this is also kind of beyond this cost, but subsequently, the firm is going to record interest payment every period. And then they're going to do some amortization of this premium or of this discount. So eventually, at maturity, if the accounting is done right, the discount on bond payable is going to go to zero. Or if the firm has any premium on bond payable, it's going to go to zero as well. And what is left on the firm's book is only going to be the face value of the bond payable. So no matter whether the bond is issued at premium or discount or face value, the book value of the bond at maturity will always be equal to its face value. So if you want to ask why, we're going to talk about it in more detail in more advanced financial accounting course, and it's kind of beyond this course. But the conclusion here is After amortization, the any discount or premium is going to go to zero. So what is left for the book value is only going to be the face value of the bond. Here's an example. So assume the firm retired the bond at its maturity. What is the journal entry? And the journal entry here is basically because the only thing that is left is the face value of the bond. So we basically only need to debit bond payable for its face value, which is 100,000, credit cash 100,000. So this is redeeming the bond at maturity. And sometimes the firm may decide to redeem the bond before maturity. So what we do here is basically we remove everything associated with the bond from its book. So eliminate carrying value of the bond. Record cash paid, whatever cash the firm received. And if it's not balanced, there's going to be any gain or loss on redemption, we need to record that as well. So let's look at an example here. The firm sold its bond at a premium and retired the bond after paying the annual interest. The carrying at the time of retirement, the carrying value of the bond is 100,400. What is the journal entry to record redemption? So here, the face value of the bond is 100,000. So when the firm retired the bond, so the bond payable is at the credit side. In order to write it off, we debit bond payable 100,000. And the firm gets 103,000 cash. So we the firm used 103,000 cash. So we credit cash 103,000. The carrying value of the bond is 100,400. So which is basically at the credit side, the firm's bond payable is 100,000. And there's going to be some premium, unamortized premium on bond payable, which is 400. So we need to write this off to zero. We need to write this off to zero as well by debit premium on bond payable 400. And this journal entry doesn't balance. The imbalance is at the debit side of 2,600. And this is going to be loss on bond redemption. So basically what's happening here is the bond, which only has 100,200 net book value on its book. It is the firm spent 103,000 to redeem it. So it is occurring a loss of 2,600. So this is the redemption of bond before maturity. And lastly, let's talk about how liabilities are reported on its balance sheet. So liabilities, it should be separated into current versus long-term. And then just different items should be reported separately on the firm's balance sheet. So this is about all I want to cover about liabilities.